Happy Friday, Wealth Press viewers and subscribers. We're here for the Friday morning market wrap, and Roger Scott joins me as usual. Roger, welcome.
Thank you. Thank you for having me so much.
You bet, Roger. So tell me, let's start off with a quick discussion about the proliferation of the virus in Florida, smashing records, yet the government is still opening the economy. I'm curious as to how you feel about that personally and how you think it's going to affect the economy more broadly.
Well, I'll be very, very honest with you. It's an interesting thing. It's like everybody's got their head in the sand over here. It's like it doesn't exist. It's really interesting. Even throughout Florida, people have a very different vibe. I'm in North Florida, and it's a lot more relaxed with the face masks here. And we went to Orlando with the kids last weekend, and it's totally a different story. Masks mandated. Can't go into shopping malls without it. Everybody's winning on the streets. Very, very different vibe. You know, it's very interesting. It's a very, very interesting vibe. And now my biggest issue, the problem I have is with schools. At first, they wanted to not open the schools. Then they said they're going to open the schools. Last night, they came out with the announcement saying they're going to push the reopening of schools 2 weeks forward. And I think this is going to have a big issue with the economy because Florida is a big state. California is still closed. If kids can't go to school, a lot of parents will have to stay home and miss jobs. So that's going to have a major financial impact on the economy, a major impact on the economy. Sure. We're talking about a lot of people.
Sure. And I've been listening to NPR a lot lately, and it's interesting because the students are advocating for a return to classrooms, but the teachers are getting very nervous because obviously they're in the age bracket that constitutes a higher risk category. And the students, obviously, due to their age, are a little bit less concerned about the risk. So, I mean, considering that the virus is proliferating and the rate of infection continues to increase, records being smashed daily, I can't imagine a scenario where schools will actually proceed to open, even if the government says they will open, because I don't think teachers are going to show up. So I do believe that the economic impact is going to be tremendously more than even is being considered at this point in the worst case scenario. So what should investors do?
Well, and I just want to further your point just really quickly and think about this. Let's just say they did open, okay? One person gets sick in class or one teacher gets sick in class and it's over for everybody. So even if they did reopen, I think it would be a very, very short, a very short reopening for a very, very short period of time.
Sure.
Well, funny that you ask. Here, we're at a very interesting crossroad with the market right now in light of the COVID-19. And I'll tell you, something very interesting happened this week. And it's the first time we've seen this since February. Very interesting. Moderna came out earlier in the week. You know, I lose track of days. I've been so busy. It might have been late last week or over the weekend or beginning of this week. But last few days, Moderna came out with a big announcement, and they put some real numbers behind it. They are saying we're going to fast track it. We're going to 30,000 people trials. We're going to have this thing licked, all right, by a certain date. And I think they said September or November. I don't remember the exact details. But something very, very drastic happened to the stock market after that announcement came out. For the first time since February, the blue chips and the non-stay-at-home stocks have actually been leading, and the stay-at-home stocks, the stocks we've been putting a premium on, all the tech, all the cloud stocks, they've been getting sold off, at least on a relative strength basis. So for the first time since February, we've seen a reversal of fortune, if you will, in the stock market in terms of characteristics of what's attracting investors right now. And I think that's very, very interesting.
Mm-hmm. So the capital flows have started to change in the market. And beyond interesting, what does that tell you in terms of your strategy for allocating capital in the market going forward?
Great question, James. Well, it's a twofold question. First of all, I believed, based on my momentum studies over the past month, I believe that technology went too far too fast. that rubber band is not stretched out like this. That rubber band is stretched out like this right now. I mean, it's at a point, and I'm talking short term. I'm talking, I have my trading hat on right now. But from a monthly or 2-3 month basis, the tech sector has been overdone for well over a month. And over that month, it's been just kind of stagnating. It hasn't really been going up too much. I mean, you'll always have that 6% of stocks in the S&P that will continue rising, but that's only 6%. And even then, the volatility is going to be there. But getting back to the point, what I see happening right now is I see myself, and I've been doing this for a while, I've been slowly moving out of technology stocks. I've been moving into basic material, real estate stocks, gold, bonds, and I still feel like there's a lot of value in specific sectors of the technology, and and other sectors. So what I believe investors should do, and this is a good practice for those people who have been taking my advice, have been writing technology higher, take out some of that capital and diversify it into a few ETFs, a few diversified ETFs. And I actually have a few for you today that I want to talk about that I think would still have a good opportunity to go up, or at least have a relative strength basis of remaining near the current levels, where a lot of technology stocks are going to be sold off. And literally, I hate to use the word taking profit because that's the same thing as taking loss, but I do think a lot of investors are going to be taking profit near the current levels.
Right. Interesting. Okay, so then what ETFs are we talking about here?
Well, there's a few. The first one is the cloud ETF. I believe till there is a vaccine on the table, the cloud, all stocks relating to the cloud are going to be hot. So the ticker symbol is WCLD, WCLD, and that's a cloud computing ETF. Cloud is the future. Forget networks, forget storage devices, the cloud. Everything is going into the cloud. The next one I really like is clean energy ETF. We're now anticipating next year, over the next 5 years, that clean energy will represent up to 50% of all usable energy in America. And people are still looking at it as a new thing. It's not. It's not new anymore at all. It's becoming part of our culture. So ACES, Clean Environment ETF. And finally, the last one I really like is DTEC. This is very interesting, James. Disruptive Technology ETF.
Wow.
You got stocks that are still in that ultra growth phase that don't have hardly any competition. Spotify is their top holding right now, to give you a little taste of what we're talking about. But if you were to look at the constituents of these stocks, of these holdings, of these ETFs, you would find that the top 3 or 4 holdings are a lot of the stocks that I've been standing behind, if you will, over the last few quarters. So a lot of these, but I like clean energy, cloud, and this disruptive technology. I don't feel comfortable being in individual stocks right now. I think the market is going to pull back. And if you are going to be in individual stocks, look at basic materials, look at real estate. Real estate, I don't know if you've noticed, but mortgage applications, they've been going higher. We're 13% higher than a year ago. We're past January levels of this year. And it makes sense. If you think about it on several fold, you've got investors who see that the Fed is not going to raise interest rates till at least 2022. They're going to take advantage of this right now. They're going to refinance their homes. A lot of people are relocating to smaller neighborhoods that have less people because of this COVID-19. There's a lot of movement in the real estate market right now, and I think that's going to continue. So I'm looking at, let me give you a couple of good stocks that I think will do really, really well. One is Penny Mac Financial Services, PFSI, the largest originator of U.S. loans, happens to be a federally backed company. Their default rate will be a lot lower as a result of that. This company's been growing 3 years, 131% growth, revenue in 3 years, 185% growth, price target of about $65 a share, and last four strong buy recommendations right now. Very, very hot stock. I just looked at mortgage applications. The report came out at 8:30 this morning. Numbers were solid. The numbers are solid. So I like this company, PFSI, and I like Lennar Homes breaking out right now, almost at new highs, LEN, ticker symbol LEN. Again, ticker symbol here for PennyMac Financial Services, PFSI, and for Lennar Homes, it's LEN. And for those of you who don't know, Lennar Homes is one of the biggest cookie cutter homes builders in the country. If you drive around America, you will see Lennar Homes everywhere, kind of like KB Homes.
Right.
So this is a massive, massive company, and the stock is coming out of a nice 2-month congestion and almost at all-time highs again. So I like those two stocks. So again, I'm starting to cool off on individual tech stocks, move more into ETFs because they're diversified, and by having that diversification, we're going to lower our exposure and diversify our volatility across several assets, which is what we want to do. So I'm becoming more defensive, but I don't want to leave the market completely dry if we have another run up. So what I'm doing is I'm creating a diversified portfolio, and I'm diversifying as much as I can to lower my exposure so that my volatility doesn't go like this, but it goes more like this.
I see. So is it time for us to diminish our exposure to tech generally?
I believe so.
Because
I do believe so.
Seem to be absolutely maxed out in value.
Well, you gotta look at it like this from several perspectives. The run up we've seen has been really, really too much too fast. So even if they're going to continue going up, I think we're going to see a good pullback before they do. The momentum levels are just jarringly overbought. That's number one. Number two, aside from momentum levels being extremely overbought, you've got earnings right now. Tech is about to start their earnings season, and remember, this whole buy-in on tech is based on perception. It's based on the premium that people have given it based on the COVID-19. It's not based on earnings. And yes, some tech companies are going to do better, but some tech companies don't benefit from the stay-at-home as much as others. So that's going to come into play over the next 2-3 weeks as well.
Right.
Then we've got elections coming up. So you've got a couple of things. You've got an overbought stock market. You've got a diverging tech sector. You've got too much too fast. You've got some non-stay-at-home stocks that are going to feel it hard on this earnings season. Only about 25% of tech is benefiting from stay-at-home directly. So you're still going to have a lot of ebb and flows. And most importantly, if what Moderna is saying is true, and they're not the only ones, then this whole stay-at-home premium is going to start fizzling away, because remember, the market always discounts everything ahead of time. So you've got, and I've been the biggest cheerleader for tech over the last two quarters, as you know, but I'm starting to feel the heat a little bit. So lowering exposure, taking profits on the individual names, putting your assets more into the disruptive technology or the cloud, which also, by the way, if you look at the constituents on the cloud ETF and the disruptive tech ETF, you will see that they hold about 90% of all stocks that I've been recommending, but in a basket form. So your exposure is going to be less. I think it's time to focus not on how much money we can make as a result of this bounce, but how we can preserve that capital, lower our volatility, and still have a chance to come out of this up and up, on the up and up.
Okay, so where does that put gold and silver in your estimation of things? Because they've both been surging higher, and gold's built a new floor above 1,800 now, And so is that a way to sort of ameliorate your exposure to tech and the market generally?
Exactly. I couldn't have said it better. And as you know, I've been talking about gold and I've been talking about interest rates now for about a month. This conversation that, gold's been making, this is not the first time you and I are having this conversation.
Yeah.
So and whenever gold makes a multi-year high, and we're what, about near 7-year high right now?
Mhm.
6 years, 7 years, somewhere in that ballpark, right? So whenever gold does that, you have to pay attention, especially in light of all the factors that we're seeing: higher volatility, interest rates that have a floor, global economy not picking up. Uh, what if what if Moderna comes out tomorrow with this COVID-19 vaccine? Okay, well, what about all the carnage we've had over the last quarter? The fact that the Fed is moving the money in, they're going to start relocating to other sectors. So I think we have to play defensive. I think we would have to be nuts not to be defensive in this type of market environment and just be exposed to technology and just say, yeah, we're going to go higher, we're going to go higher, we're going to go higher. My momentum levels are not telling me that. My momentum levels are telling me that the stock market's overbought. And I don't care how separate tech is from the broad market. When things hit the the proverbial fan, all stocks will come down. When the Dow Jones moves down 1,000 points,
Yep.
how many stocks are going to be left standing? I mean, it's just how it's just how the world works. So I think we have to kind of step back right now. We have to reassess our portfolio, and we have to say, okay, the good times have been here. We squeezed out a lot from this COVID-19, but now some things are either we're going to feel the pain from this COVID-19, or we're going to feel the pain anyway, but some of it will be offset by a cure or a vaccine or some medicine to help us deal with this, and the inflows of Fed. But one way or the other, the market, that rubber band, the longer it stays there, the faster it'll snap, the harder it'll snap. So it's just a matter of time. You would have to be nuts not to have exposure to some defensive assets right now. And I'm telling you, I'm giving you a way to kind of have your cake and eat it too, but lower your volatility, your exposure, but at the same time still keep your hand in the game, if you will.
Uh-huh. So Roger, on February 19th, the S&P touched its all-time high of 3,300, and I think it was 76 or intraday. And then by March 23rd, due to the coronavirus headline effect, the S&P had dropped more in 30 days than it ever had in its entire history. But yet here we are, another 120 points away from the all-time high again. So when you talk about a rubber band, I mean, there's no better visceral demonstration of the reality than that event right there. My question, though, is if we're going to see a resurgence of the coronavirus sort of hysteria as it pertains to headlines, and that's going to catalyze another sort of maximizing of what the range of the rubber band can be, then if we know that there's another 50% drop in the S&P coming, followed by a total resumption in buying interest over the 30-day period following, is that something we should be considering positioning for at this point?
Yes, but I don't think we're there yet. I think we're in a wait and see period right now. And I think this period is going to, I think we're going to be there closer to the mid range of earnings. Earnings just begun. This is the second week of earnings, official week of earnings. I think we have to kind of get the vibe to kind of penetrate through Wall Street to where Wall Street says, okay, even in the best case scenario, there's just not anything to look forward to. And again, a lot of traders don't realize, a lot of traders, investors, more so investors than traders, don't realize that, see, the biggest beef I have with what Wall Street is doing, with what I'm seeing, is Wall Street is talking about this not as a reaction from what happened in February. They're talking about this as a new bull market run. And I'm looking at it as I'm looking at the movie from a bigger picture. And I'm still seeing what's happening in the market now being completely triggered by what happened in February.
Mhm.
So to me, this movie is still playing out, and it's not, the movie didn't finish, and it's not a new series. It's a continuation. And that's how we have to look at it. So that rubber band went like this, it went like this, and now it's back like this. But the movie will end once it stabilizes, till it evens out, and till we have an equilibrium. It's a continuation. So I want everyone listening to this to understand the last couple of months is a reaction. It's a reactory uh, trading action from what happened. It's a response based on what happened in February. It's not the market standing on its own 2 feet. Basically, imagine someone dropping a ball from a 100-story building, all right? That ball is going to rise. It's going to bounce, not
Right.
because that ball has some super magic powers. It's called physics.
Right.
And the market is experiencing that. What we're seeing right now is a reaction of that bounce. It's not someone inventing a ball that can fly. It's a simple reaction, and ultimately that ball has to come down. Now, once it's on the ground and once it's just sitting there, then I'll reevaluate the market on its own. But while that ball is still doing this, it's hard to look at the market on its own. We have to look at it as a reflectory. For example, if you saw someone drop a ball and you saw that ball bounce, you wouldn't say, okay, once it bounces, once it hits ground, we start it fresh. No, you would say it's just simply having a reaction. Well, what we're seeing is exactly that, except in slow motion. That it bounced hard, we're going up, and right now that ball is it's thinking, can I go higher? Can I go higher or no? And it's just kind of sitting there. It's that rubber band, and we're at a crux, at a crest of the tidal wave, as I like to say it.
Right. Okay. Well, that's interesting. I love the use of physics, because I often look at the market and think that the laws of thermodynamics and physics tend to apply in the marketplace too. And so certainly, when you consider the concepts when it comes to bodies in motion of velocity, inertia, momentum, etc., the rubber band theory really fits in with that. And of course, then you add the added dimension of shear, where the breaking point of all things are ultimately hit at some point. There's nothing that doesn't have a breaking point. But then it's interesting to me that you are sort of positing the concept that the stability will be indicative of the end of a cycle. And so are you suggesting that we have some stability to look forward to? Because I mean, we really haven't seen stability in the marketplace, unless you consider the meteoric rise of tech stocks a consistency, which I guess it is. But the volatility's been there, and we've never seen volatility in the market like this. Mind you, we've never seen such a solid incline in valuations like this. So are you suggesting that we do have a period of stability to look forward to somewhere on that timeline?
Possibly a period of about 6 months of stability when the markets completely rebalance themselves. I believe it'll happen, but it's too early right now. We have to see how the elections go. We have to see how earnings go. There's just so many things on the table. It's not going to happen till at least another 2 quarters.
Okay. Roger, that's fantastic insight as usual. I really appreciate your participation and input. Have a great weekend, and I look forward to seeing you at the roundtable on Monday.
Thank you, James, and thank you for having me, and have a wonderful weekend.